Adjustable life policies, blended combination, are distinguished by their flexibility that comes from combining term and whole life insurance into a single plan. The policy owner determines how much face amount protection is needed and how much premium the policy owner wants to pay. Adjustable life insurance allows you to vary your coverage as your needs change without requiring evidence of insurability. Consequently, no new policy needs to be issued when changes are desired. Adjustable life has all the usual features of level premium cash value life insurance. Universal life is a variation of whole life insurance, characterized by considerable flexibility. Changes may be made with relative ease by the policy owner with these flexible premium policies. Investment gains go towards cash value. Unlike whole life with its fixed premiums, fixed face amounts, and fixed cash value accumulations, universal life allows its policy owners to determine the amount and frequency of premium payments which will adjust the policy face amount. Basic characteristics of a universal life policy are flexible premiums, flexible benefits, no minimum death benefit, and cash value withdrawals. Cash value accumulations are subject to a minimum interest guarantee. Any surrender charges of a universal policy must be disclosed. Target premium is the suggested premium used in universal life policies. It does not guarantee there will be adequate funds to maintain the policy to any time, especially to life. It may give an indication of what will be needed under conservative estimates to maintain the policy. Equity Index Universal Life Insurance, a permanent life insurance policy that allows policyholders to tie accumulation values to a stock market index, like the S&P 500. Indexed universal life insurance policies typically contain a minimum guaranteed fixed interest rate component along with the indexed account option. Indexed policies give policyholders the security of fixed universal life insurance with the growth potential of a variable policy linked to indexed returns. Potential extra interest based on the investments of the company's general account. Modified endowment contracts (MEC), a policy that is overfunded, according to IRS tables, is classified as a modified endowment contract. Policies that do not meet the 7-pay test are considered MECs and will lose favorable tax treatment. The 7-pay test is a limitation on the total amount you can pay into your policy in the first 7 years of its existence. The test is designed to discourage premium schedules that would result in a paid-up policy before the end of a 7-year period. For example, if yearly premium is $500, in a 7-year period the total amount paid would equal $3,500. If you paid $3,501, it has now exceeded the 7-pay test and is no longer a life insurance contract. It will now be taxed as an investment. If withdrawn prior to age 59, there is a 10% penalty. Taxation only occurs when cash is distributed. Funds withdrawn from a MEC are subject to last in first out (LIFO) tax treatment, which assumes that the investment or earnings portion of the contract's values is withdrawn first, making these funds fully taxable as ordinary income. Penalty taxes on premature distributions from a modified endowment contract (MEC) normally apply to 17 policy loans. Variable insurance products. Note: because of the transfer of investment risk from the insurer to the policy owner, variable insurance products are considered securities contracts as well as insurance contracts. A producer is required to register with the National Association of Securities Dealers to sell variable products. Variable whole life insurance was created to help offset the effects of inflation on death benefits. It's permanent life insurance with many of the same characteristics of traditional whole life insurance. The main difference is the manner in which the policy's values are invested. With traditional whole life, these values are kept in the insurer's general accounts and invested in conservative investments selected by the insurer to match its contractual guarantees and liabilities. With variable life insurance policies, the policy values are invested in the insurer's separate accounts which house common stock, bond, money market, and other securities investment options. Values held in these separate accounts are invested in riskier, but potentially higher yielding, assets than those held in the general account. The basic characteristics of a variable life policy are fixed premiums, a guaranteed minimum death benefit which fluctuates over the minimum, and cash values which fluctuate and are not guaranteed. Variable universal whole life (VUL) is a type of life insurance that builds cash value. It combines all the characteristics of a universal life and variable life. In a VUL, the cash value can be invested in a wide variety of separate accounts, similar to mutual funds, and the choice of which of the available separate accounts to use is entirely up to the contract owner. The variable component in the name refers to the ability to invest in separate accounts whose values vary. They vary because they are invested in stock and/or bond markets. The universal component in the name refers to the flexibility the owner has in making premium payments. This provides a policy owner with flexible premiums, adjustable death benefits, a guaranteed minimum death benefit, and gives the insured growth potential for higher returns, but also potential for loss. Evidence of insurability can be required for an individual covered by a variable universal life policy when the death benefit is increased. 18 Life insurance provisions, options, and riders. Required provisions. Insuring clause or insuring agreement, the insurer's basic promise to pay specified benefits to a designated person in the event of a covered loss. The insuring clause is a part of the health insurance policy that states the kind of benefits provided and the circumstances under which they will be paid. The purpose of the insuring clause in an insurance policy is to specify the scope and limits of the coverage provided. The insuring clause is a part of the insurance policy that identifies the specific type of benefits or services that are covered by that policy and the circumstances under which they will be paid. Any promises the insurer makes will be in the insuring clause. Consideration clause. A policy owner must pay a premium in exchange for the insurer's promise to pay benefits. A policy owner's consideration consists of completing the application and paying the initial premium. The amount and frequency of premium payments are contained in the consideration clause. In insurance, the insurance company exchanges the promises in the policy for a two-part consideration from the insured. Consideration is an exchange of something of value on which a contract is based. An insurance contract is valid only if the insured provides consideration in the form of the initial full minimum premium required and the statements made in the application. The applicant begs, "Please consider me for insurance. Here is my completed application, my initial premium, and how much money how often I agree to pay. Please consider me." Entire contract. The entire contract includes the actual policy and the application. It states that nothing outside of the contract includes the signed application and any attached policy riders can be considered part of the contract. It also assures the policy owner that no changes will be made to the contract or waive any of the provisions after it has been issued, even if the insurer makes policy changes that affect all policy sales in the future. This, however, does not prevent a mutually agreeable change or modifying the contract after it has been issued. Any change to a policy must be made with the approval of an executive officer of the insurance company, whose approval must be endorsed on the policy or attached in a rider. This mandatory health policy provision states that the policy, including endorsements and attached papers, constitutes the entire insurance contract between the parties. We can't send you additional paperwork later. The entire policy and application is sent to you and that makes up your entire contract. Grace period. The period of time policy owners are allowed to pay an overdue premium during which the policy remains in force, usually 30 days. If an insured died during the grace period of a life insurance policy before paying the required annual premium, the beneficiary will receive the face amount of the policy less any required premiums. The purpose of the grace period is to give the policy owner additional time to pay overdue premiums. The policy owner is given a number of days after the premium due date during which time the premium payment may be delayed without penalty and the policy continues in force. Grace period is the same definition for your insurance bill as it is for all of your other bills. Don't pick it as an answer if the question isn't talking about paying your bill late and keeping your insurance. 19 Reinstatement permits the policy owner to reinstate a policy that has lapsed as long as the policy owner can provide proof of insurability and pays all back premiums, outstanding loans, and interest. Most states allow reinstatement up to 3 years after a policy has lapsed. However, some states are 5-7 years. The reinstatement provision specifies that if an insured fails to pay a renewal premium within the time granted but the insurer subsequently accepts the premium, coverage may be restored. Under certain conditions, a policy that has lapsed may be reinstated. Reinstatement is automatic if the delinquent premium is accepted by the company or its authorized agent and the company does not require an application for reinstatement. If it takes no action on the application for 45 days, the policy is reinstated automatically. To reinstate any policy, you need A reinstatement application, statement of good health, all back premiums. Incontestable clause, the clause in a life insurance contract that prohibits the insurer from questioning the validity of the contract after a certain period of time has elapsed. Misstatement of age or sex, allows the insurer to adjust the policy benefits if the insured's age or sex is misstated on the policy application. The misstatement of age provision allows the insurer to adjust the benefit payable if the age of the insured was misstated when application for the policy was made. The insurer can adjust the benefit to what the premiums paid would have purchased at the insured's actual age. If the insured was older at the time of application than is shown in the policy, benefits would be reduced accordingly. The reverse would be true if the insured were younger than listed in the application policy loan provisions. Policies that have cash value also have policy loan and withdrawal provisions. These policies must begin to build cash value after a certain number of years. In most states, this is 3 years. These loans, with interest, cannot exceed the guaranteed cash value or the policy is no longer in force. The policy owner has the right to the policy's cash value. Policy loans are not taxable. Any loans with interest due at the time of death will be deducted from the insured's policy proceeds. Automatic premium loans allows the insurer to automatically use the policy cash value to pay an overdue premium. There is no cost for this provision. Automatic premium loans, like using a savings account for overdraft protection, but there is no fee, just interest for borrowing your money. If you don't pay it back, interest is added to the loan. It also will be subtracted from any death benefit or cash surrenders if not paid back first. Other insurance provision, also known as dependent riders, may be added to a primary policy to cover a spouse or another insured, children or adopted children. Owner's rights provision defines the person who may name and change beneficiaries, select options available under the policy, and receive any financial benefits from the policy. Assignment clause or provisions, the right to transfer policy rights to another person or entity. The new owner is known as the assignee. Absolute assignment, when the assignee receives full control of the policy and rights to the policy benefits from the current policy owner. Under an absolute assignment, the transfer is complete and irrevocable, and the assignee receives full control over the policy and full rights to its benefits. Collateral assignment, the partial and temporary transfer of rights to another person or entity. Collateral assignments are usually intended for securing a loan with a creditor. A collateral assignment is one in which the policy is assigned to a creditor as security, or collateral, for a debt. If the insured dies or sometimes becomes totally permanently disabled, the creditor is entitled to be reimbursed out of the benefit proceeds for the amount owed. The insured's beneficiary is then entitled to any excess of policy proceeds over the amount due to the creditor. Free look. The policy owner is permitted a certain number of days once the policy is delivered to look over the policy and return it for a refund of all premiums paid. Notice of claim. The notice of claim provision describes the policy owner's obligation to notify the insurance company of a claim in a reasonable period of time. Typically, the period is 20 days after the occurrence or a commencement of the loss, or as soon thereafter as is reasonably possible. You need to let the insurance company know that you are going to be filing a claim, so they are expecting your claim forms. Claim forms. It is the company's responsibility to supply a claim form to an insured within 15 days after receiving notice of claim. If the insurance company fails to send out the claim forms within the time period required by the provision, the insured should submit the claim in any form, which must be accepted by the company as adequate proof of loss. You can submit your claim using a napkin and crayon as long as you provide all the necessary information. Proof of loss. The statement that an insured must give an insurance company to show that a loss actually occurred as a proof of loss. After a loss occurs, or after the company becomes liable for periodic payments, for example, disability income benefits, the claimant has 90 days in which to submit proof of loss. Insurance company can't pay you if you don't prove there is a loss. Time of payment of claims. The time of payment of claims provision provides for immediate payment of the claim after the insurer receives notification and proof of loss. If the claim involves disability income payments, they must be paid at least monthly, if not at more frequent intervals specified in the policy 21. The purpose of the time of payment of claims provision is to prevent the insurance company from delaying claim payments. You did your part, paid your bill and got injured, sick, etc. Now the insurance company must immediately do our part, pay you, and it can't be less often than monthly, or you wouldn't be able to pay your bills. Payment of claims. The payment of claims provision in an insurance contract specifies how and to whom claim payments are to be made. Payments for loss of life are to be made to the designated beneficiary. If no beneficiary has been named, death proceeds are to be paid to the deceased insured's estate. Claims other than death benefits are to be paid to the insured. Should the insurance company pay you, or the doctor, or someone else? Physical exam and autopsy. The physical exam and autopsy provision entitle a company, at its own expense, to make physical examinations of the insured at reasonable intervals during the period of a claim, unless it's forbidden by state law. Forget everything you learned on Law and Order, only the state can forbid an autopsy. You gave up your and your family's rights to refuse when you applied for insurance. Legal actions. The insured cannot take legal action against the company in a claim dispute until after 60 days from the time the insured submits proof of loss. Beneficiary designation, where the policy owner indicates who is to receive the proceeds. Change of beneficial with insured, as policy owner, may change the beneficiary designation at any time unless a beneficiary has been named irrevocably. Settlement options. Payment of claims, where the ways in which the proceeds can be paid out or settled are explained. Excess interest provision. If a beneficiary decides to leave life insurance proceeds with an insurer following the death of the insured, the insurance company must pay interest on the proceeds. The interest credited to or paid to the beneficiary is taxable as ordinary income. 22. Discretionary provision limits the way a court can review a claim denial and makes it difficult for the court to conduct a fair review of the claim. Some states have enacted laws that prohibit discretionary provision because they are designed to protect the insurance company. Change of occupation. This provision also allows the insurer to reduce the maximum benefit payable under the policy if the insured switches to a more hazardous occupation, or to reduce the premium rate charged if the insured changes to a less hazardous occupation. Unpaid premiums. If there is an unpaid premium at the time a claim becomes payable, the amount of the premium is to be deducted from the sum payable to the insured or beneficiary. Cancellation. Though prohibited in a number of states, the provision for cancellation gives the company the right to cancel the policy at any time with 45 days written notice to the insured. This notice must also be given when the insurer refuses to renew a policy or change the premium rates. If the cancellation is for non-payment of premium, the insurer must give 10 days written notice to the insured, unless the premiums are due monthly or more frequently. The cancellation provision also allows the insured to cancel the policy any time after the policy's original term has expired by notifying the insurer and writing conformity with state statutes. Any policy provision that is in conflict with state statutes in the state where the insured lives at the time the policy is issued is automatically amended to conform with the minimum statutory requirements. Illegal occupation. The illegal occupation provision specifies that the insurer is not liable for losses attributed to the insured's being connected with a felony or participation in any illegal occupation. Intoxicants and narcotics. The insurer is not liable for any loss attributed to the insured while intoxicated or under the influence of narcotics. Losses due to injuries sustained while committing a felony, or attempting to do so, also may be excluded. Right to defer loan. This provision grants the right to an insurer to defer a policy loan or the payment of the cash value in most states up to 6 months after its request. This right does not apply to the payment of death claims. It is 23 designed to protect an insurer if a large amount of policyholders desire to make withdrawals at the same time. The policy facet policy face contains a summary of the type of policy and the coverage provided by the policy. It identifies the insured, the term of the policy, the effective date and termination date, and how the policy can be renewed. Guaranteed insurability option rider allows a policy owner to purchase additional life insurance coverage at specified dates without providing evidence of insurability. Payor provision rider provides waiver of premiums if the adult premium payor should die or, with some policies, become totally disabled. Accidental death benefit rider double indemnity provides an additional amount of insurance usually equal to the face amount of the base policy if the cause of death was an accident. Common exclusions or restrictions or exclusions, a feature of a life insurance policy stating that the policy will not cover certain risks. Exclusions and restrictions are situations or conditions which are not covered or covered with substantial limits. Thicomanonther injuries due at or an software, self-inflicted injuries, and those he incurred while the insured is serving as a pilot or crew member of an aircraft. Other exclusions are as resulting from suicide, hernia, an accidental injury, riots, or the use of drugs or narcotics. Losses due to injuries sustained while committing a felony, or attempting to do so, also may be excluded. Foreign travel may not be excluded in every instance, but extended stays overseas or foreign residence may cause a loss of benefits. Occupational injuries and illnesses are covered by workers' compensation and typically excluded. The exclusion section is not included in the policy phase. First page of an insurance policy. Suicide clause. The policy will be voided, and no death benefit will be paid if the insured commits suicide within 1 year from policy issuance. The primary purpose of a suicide provision is to protect the insurer against the purchase of a policy in contemplation of suicide. Aviation. The insurer will not pay the claim if the insured is due to involvement with aviation, such as a military pilot flying a jet aircraft. Or military service. The insurer will not pay the claim if the insured is while in active military service or due to an act of war. Hazardous occupation or hobby. If the insured is as a result of a hazardous occupation or hobby, the insurer will not pay the claim. 24 Waivers for impairments. When an insurance company does not cover a loss due to a specific condition the insured has, this is usually called an impairment rider. If the insured's condition improves, the company may be willing to remove the waiver. Policy options. Non-forfeiture options. You are closing your account, surrendering your policy. What do you want us to do with your cash so you don't forfeit it? When a policy owner decides he does not want his life insurance policy anymore, he has the option to surrender his policy. If there is cash value remaining, he must use one of the following non-forfeiture options. Cash surrender allows the policy owner to receive the policy's cash value. Policy owner no longer has coverage at this point. Normally, the maximum length of time a life insurance company may legally defer paying the cash value of a surrendered policy is 6 months. Delayed payment provision. Extended term option permits the policy owner to use the policy's cash value to buy level, extended term insurance for a specified period. No premium payments are made. The coverage provided with the extended term non-forfeiture option is equal to the net death benefit of the lapsed policy. Reduced paid-up option. The policy owner pays no more premiums but the face amount is decreased. Dividend options. Participating policies pay dividends to policy owners if the company's operations result in a divisible surplus. Recall that dividends are a return of overcharged premiums and are therefore not taxable. Insurers typically pay dividends on an annual basis. The following dividend options are available to policy owners for settling dividend payments. Cash option. Take the cash, it's your money, you can take it and run. Reduced premiums option. Reduces premium payments, just keep them and next year don't charge me so much. Accumulate interest option. Allows dividends to accumulate interest. Interest is the only thing you can be charged tax on. Paid up additions option. Purchase single payment whole life coverage. 1-year term option. Purchase 1-year term protection. Keep in mind, with dividends, the policy is still active. Policy rider's waiver of premium rider allows the policy owner to waive premium payments during a disability and keeps the policy in force. It does not provide cash payments to the policy owner. The disability must be total and permanent and have sustained through the waiting period 90 days or 6 months. After a certain age, usually 60 or 65, the 25-26 waiver of premium rider is void. Waiver covers the primary insured. Does not provide income. Is not a loan. The insurance company is waiving the premiums. It's just as if the insured made the premiums every month. Payor rider or payor clause. If the individual paying the premiums on a juvenile life policy becomes disabled or dies, the payor rider ensures that premiums will be waived. Accelerated benefit rider allows the insured to receive a portion of the death benefit prior to death if the insured has a terminal illness and expected to die within 1-2 years. Whatever amount is withdrawn in an accelerated death benefit will decrease the death benefit when death occurs. Accelerated benefit. Your doctor said you are going to die, so you aren't going to stop paying your insurance since you know you'll need it soon. Insurance company now knows you are going to die soon, which means they are going to have to pay out the benefit. To make things a little easier and less stressful, they will give you some of the proceeds now and deduct from what would go to your beneficiary at your death. Accidental death benefit rider, multiple indemnity, pays an additional sum to the beneficiary if the insured dies due to an accident. The amount paid is a multiple of the policy face amount, such as double or triple the original benefit. Truly the cheapest way to add a lot of coverage for a period of time. Accidental death and dismemberment may be added to a life insurance policy. Pays benefits for dismemberment and accidental death. Pays a principal sum for loss of both hands, both arms, both legs, or loss of vision in both eyes. Addend, face value equals amount for accidental loss or loss of 2 hands, feet, eyesight, etc. 12 face value for loss of 1 foot, hand, eye, etc. 1 foot and 1 hand equals 100% face value. Guaranteed insurability rider, future increase option, permits the policy owner to buy additional permanent life insurance coverage at specific points of time in the future without submitting proof of insurability. It also includes specific events like marriage and births, without requiring the proof of insurability. Usually the benefit is allowed every 3 years, up to the original face amount of the policy. Cost of living rider, allows the policy face amount to be adjusted to account for inflation based on the Consumer Price Index. Return of premium rider, pays the total amount of premiums paid into the policy in addition to the face value, as long as the insured dies within a certain time period specified in the policy. It also returns premiums to the living insured at the end of a specified period of time, as long as the premiums have been paid. Automatic premium loan rider, allows the insurance company to deduct overdue premium from an insured's cash value by the end of the grace period if a payment is missed on a life policy. The insurance company can automatically take out a loan for you against your cash value to cover your premium in the event they don't receive payment from you. This can continue for as long as they don't receive a payment and you still have cash value. Once all of your cash value is gone, if you don't start paying, your policy will lapse. This is just like any other cash value loan. Exchange privilege rider, this rider permits a policy owner to exchange a life insurance policy for another in the future if desired. As more advantageous products are developed in the future, this rider allows a policy owner to take advantage of a policy that may be more suitable. Life insurance premiums, proceeds and beneficiaries. Primary factors in premium calculations. Once an insurance company determines that an applicant is insurable, they need to establish the payment premium for the insurance policy. Life insurance premiums are calculated based on the following 3 primary factors. 1. Mortality factor. 2. Interest factor. 3. Expense factor. Mortality factor, a measure of the number of deaths in a given population. Insurance companies use mortality tables to help predict the life expectancy and probability of death for a given group. Interest factor, insurance companies invest the premiums they receive in an effort to earn interest. The rate of earnings on investments is one of the ways an insurance company can reduce premium rates. A large portion of every premium received is invested to earn interest. The interest earnings reduce the premium amount that otherwise would be required from policy owners. Expense factor. Insurance companies are just like any other business. They have operating expenses which need to be factored into the premiums. The expense factor is also known as the loading charge. Each insurance policy an insurer issues must carry its proportionate share of the costs for employees' salaries, agents' commissions, utilities, rent or mortgage payments, maintenance costs, supplies, and other administrative expenses. Benefits. The number and kinds of benefits provided by a policy affect the premium rate. The greater the benefits, the higher the premium. To state it another way, the greater the risk to the company, the higher the premium. Other factors that impact the premium amount include age. The older the person, the higher probability of death and disability. Sex. Gender. Women tend to live longer than men, so their premiums are usually lower. Health. Poor health increases probability of death and disability. Occupation. Hazardous job increases the risk of loss. Hobbies. High-risk hobbies also increase the risk of loss. Habits. Tobacco use presents a higher risk than non-smokers. Remember, these are typically only important at time of application. If you tell them you never went skydiving and that is true, then 5 years later you go skydiving for the first time and die, they will pay. Mode refers to the premium payment schedule and permits the policy owner to select the timing of premium payments. Insurance policy rates are based on the assumption that the premium will be paid annually at the beginning of the policy year, and that the company will have the premium to invest interest factor for a full year. If the policy owner chooses to pay the premium more than once per year, example monthly, quarterly, 27 semi-annually, there normally will be an additional charge, because the company will have additional charges in billing and collecting the premium payments. The more payments you make, the more it is going to cost you overall. Ideally, if you could make one payment in a lump sum to start and pay up the policy, you would save the most amount of money. Also, your cash value would begin accumulating right away. The higher your premium payments are, the quicker you accumulate cash value. Premium payment options: annual, semi-annual, quarterly, monthly. Note: the higher the frequency of payments equals higher premiums. Level premium funding: the policy owner pays more in the early years for protection to help cover the cost in later years, which allows the premiums to remain level throughout the life of the policy. The shorter the premium paying period, the higher the premiums, and vice versa. Single premium funding: the policy owner pays a single premium that provides protection for life as a paid-up policy. Normally associated with whole life insurance reserves versus cash value reserves, money that together with future premiums, interest, and survivorship benefits will fulfill an insurance company's obligations to pay future claims. Cash value: cash value applies to the savings element of whole life insurance policies that are payable before death. However, during the early years of a whole life insurance policy, the savings portion brings very little return compared to the premiums paid. Comparing life insurance policy costs: life insurance cost comparison methods are used to evaluate the cost of one life insurance policy in relation to another so that consumers can be better informed when shopping for the most competitively priced offering for their particular needs. Although the cost of life insurance depends largely upon an individual's specific circumstances and requirements, cost estimates are nonetheless useful so that the consumer has the opportunity to consider every factor when making a buying decision. When evaluating different policies, it's not enough to simply compare premiums. A lower premium does not automatically mean a lower cost policy. To that extent, cost indexes have been developed to help in the process of measuring an insurance policy's actual cost. Here are two of these indexes. Surrender Cost Index uses a complicated calculation formula where the net cost is averaged over the number of years the policy was in force to arrive at the average cost per thousand for a policy that is surrendered for its cash value at the end of that period. Net Payment Cost Index uses the same formula as the Surrender Cost Index, with the exception that it doesn't assume that the policy will be surrendered at the end of the period. The Net Payment Cost Index is useful if one's primary concern is the amount of death benefits provided in the policy. It is helpful in comparing future costs, such as in 10 to 20 years, if one will continue to pay premiums and does not take the policy's cash value. 28 additional methods of comparing cost also include an interest-adjusted cost method and a traditional net cost method. The interest-adjusted cost method involves a procedure for calculating the cost of life insurance, taking into account the time value of money, that is, the investment return on sums placed in premium dollars had these sums been invested elsewhere. The traditional net cost method does not take into consideration the time value of money. It adds a policy's premiums and subtracts dividends, if any, and cash value. Tax treatment of premiums. Premiums paid on individual life insurance policies are generally not deductible. Premiums for life insurance used for business purposes are generally not tax deductible. Here are the exceptions to these rules. Premiums used for a charity are tax deductible. Life insurance premiums paid by an ex-spouse as court-ordered alimony are tax deductible. Employer-paid premiums used to fund group life insurance for the benefit of employees are tax deductible. Tax treatment of cash value. If cash value is surrendered, the portion that exceeds the premiums paid is taxable. For policies that are not surrendered, the cash value grows tax-free. As long as the cash value stays in the policy, taxes will never be imposed on any portion, not even the amount that exceeds the cost basis. Policy proceeds. Death benefits. Death benefits are paid out in a variety of ways. These methods are known as settlement options. The policy owner may select a settlement option at the time of the application and may change the option at any time during the life of the insured. In most cases, However, the settlement selection is made by the beneficiary at the time of the insured's death. If the beneficiary is paid in a lump sum, it will be tax-free. Claims are rarely negotiated and only delayed if insurer does not receive notification of death. Death benefit settlement options: payment of claims. Lump sum, death benefit is paid in a single payment, minus any outstanding policy loan balances and overdue premiums. The lump sum option is considered the automatic or default option for most life insurance contracts. Interest only. Insurance company holds death benefit for a period of time and pays only the interest earned to beneficiaries. A minimum rate of interest is guaranteed, and the interest must be paid at least annually. Fixed period, also called period certain. The fixed period option is when the insurer pays proceeds, including interest and principal, in minimum guaranteed dollar payments over a specified number of years. Part of the installments paid to a beneficiary consists of interest calculated on the proceeds of the policy. The dollar amount of each installment depends upon the total number of installments. Fixed amount. The fixed amount installment option pays a fixed death benefit in specified installment amounts until the proceeds are exhausted. The larger the installment payment, the shorter the payout period. Life income. The life income option provides the beneficiary with an income that they cannot outlive. Installment payments are guaranteed for as long as the recipient lives. The amount of each installment is based on the recipient's life expectancy and the amount of principal. This gives the potential for a greater 29 return, or the potential for greater loss, based on how long the insured lives. Joints and survivor benefits will be paid on a lifelong basis to 2 or more people. This option may include a period certain, and the amount payable is based on the ages of the beneficiaries. Living benefits. A living benefit is the option to use some of the future death benefit proceeds when they may be most needed, before their death, when the insured has a terminal illness. Living benefit options. Accelerated benefit allows someone that a physician certifies as terminally ill to access the death benefit. The amount of benefit received will be tax-free. Viatical settlement allows someone with a terminal illness to sell their existing life insurance policy to a third party for a percentage of the death benefit. The new owner continues to make the premium payments and will eventually collect the entire death benefit. Note: the original policy owner is called the viator and the new third-party owner is called the viatical, or sometimes referred to as the viatee. Minimum deposit. This is a method of financing life insurance and not an actual type of policy. It is best suited for individuals in high marginal tax brackets. It allows the policy owner to use policy loans to pay premiums due each year. For example, the policy owner is allowed each year to borrow, subject to certain tax restrictions, that year's cash value increase and use it to pay the premium. The policy owner only pays the difference between the premium due and the amount borrowed, plus interest on the policy loan. Tax treatment of proceeds. Premiums, not tax-deductible. Death benefit, tax-free if taken as a lump sum to a named beneficiary. Proceeds pass directly to the beneficiary and are not subject to attachment by the insured's creditors. Death benefit installments. Principal is tax-free, interest is taxable. Taxation of proceeds paid at death. Life insurance proceeds paid to a beneficiary are usually tax-free if taken as a lump sum. The exception to this rule is the transfer for value rule, which applies when a life insurance policy is sold to another party before the insured's death. Another tax cost typically associated with death is the federal estate tax, although most relatively simple estates do not require the filing of an estate tax return. Taxation of proceeds paid during the insured's lifetime. Policy surrender. When a policy is surrendered for the cash value, some of the cash value received may be taxable, if the value was more than the amount of the premiums paid for the policy. Accelerated death benefit. When benefits are paid under a life insurance policy to a terminally ill person, the benefits are received tax-free. To be considered terminally ill, a physician must certify that the person has a condition or illness that will result in death in 2 years. Note: most states still require a viatical company to inform the client that under a viatical arrangement the 30 proceeds could be taxable in certain situations and recommend they consult a tax advisor. 1035 Exchange. When an existing life insurance policy is assigned to another insurer for a new contract, the transaction may be treated for tax purposes as a Section 1035 exchange. Policy exchanges that qualify as a 1035 exchange are not taxable. Beneficiary's qualifications. There are very few restrictions on who may be named beneficiary of a life insurance policy. The policy owner is the ultimate decision maker. However, in the underwriting process, the underwriter may consider the issue of insurable interest. When the policy owner lists themselves as the beneficiary, they will require proof of insurable interest. Remember, insurable interest only applies at time of application. Who can be beneficiaries? Individuals, businesses, trust, estates, charities, minors. Class having a group named as the beneficiary instead, such as the children of the insured. Types of beneficiaries. A beneficiary can be either specific, a person identified by name and relationship, or a class designation, a group of individuals such as the children of the insured. If no one named, or if all beneficiaries die before the insured dies, death benefit will go to insured's estate. By order of succession. Primary, first in line to receive death benefit proceeds. Secondary, contingent, second in line to receive death benefit proceeds if primary beneficiary dies first. Tertiary, third in line to receive death benefit proceeds. If no one named, death benefit will go to insured's estate. Distribution by descent. Per stirpes, meaning by the bloodline. In the event that a beneficiary dies before the insured, benefits from that policy will be paid to that beneficiary's heirs. Per capita, meaning by the head, evenly distributes benefits among all named living beneficiaries. Changing a beneficiary. A policy owner may change the beneficiary at any time. There may be limitations, however. Revocable beneficiary. The policy owner may change the beneficiary at any time without notifying or getting permission from the beneficiary. 31. Irrevocable beneficiary. An irrevocable designation may not be changed without the written consent of the beneficiary. The irrevocable beneficiary has a vested interest in the policy, therefore the policy owner may not exercise certain rights, such as taking out a policy loan, without the consent of the beneficiary. There are two common methods of changing a beneficiary available if the policyholder wishes to make a change. They are the filing or recording method and the endorsement method. The filing method is the predominant method used and requires that the policyholder notify the insurer in writing of the desired change. The effective date of the change is the date of the request. Some insurers require that the request be signed by a witness. When the endorsement method is utilized, the insurer requires that the policy be returned to the insurer so that the new beneficiary designation is added to the policy. Special situations. Simultaneous death. If the insured and the primary beneficiary die at approximately the same time for a common accident with no clear evidence as to who died first, the Uniform Simultaneous Death Act law will assume that the primary died first. This allows the death benefit proceeds to be paid to the contingent beneficiaries. Common disaster provision. With a common disaster provision, a policy owner can be sure that if both the insured and the primary beneficiary die within a short period of time, the death benefits will be paid to the contingent beneficiary. Spendthrift clause prevents a beneficiary from recklessly spending benefits by requiring the benefits to be paid in fixed amounts or installments over a certain period of time. Facility of payment allows the insurance company to pay all or part of proceeds to someone not named in the policy that has a valid right. This is usually done on behalf of a minor or when the named beneficiary is deceased. 32. Life insurance underwriting and policy issue. Proposal of underwriting. 33. Underwriting is another term for risk selection. It is the process used by an insurance company to determine whether or not an applicant is insurable and if so, how much to charge for premiums. The underwriter will utilize several different types of information in determining the insurability of the individual. This is called risk classification. Material facts can affect an applicant being accepted or rejected. One of the main responsibilities of an underwriter is to protect the insurer against adverse selection. Underwriting process. The underwriting process involves reviewing and evaluating information about the applicant and establishing individual against the insurer's standards and guidelines for insurability and premium rates. The larger the policy, the more comprehensive and diligent the underwriting process. The most common sources of underwriting information include 1. The application. 2. The medical report. 3. Attending physician's statement. 4. The Medical Information Bureau. 5. Special questionnaire. 6. Inspection report. 7. Credit reports application. The application is the starting point and basic source of information used by the insurance company in the risk selection. Although applications differ from company to company, they all have the following same components. Insurable interest must exist between the policy owner and insured at the time when the application is made. Insurable interest exists when the death of the insured would have a clear financial impact on the policy owner. Note, with a few exceptions, that is, buying insurance on a minor, a person may not purchase life insurance on another without their consent. Application Part I of the application. General information: age, DOB, sex, address, marital status, occupation. Details about the requested insurance coverage, O type of policy, O amount of insurance, O nominee and relationship of the beneficiary, O other insurance the proposed insured owns. Other information: personal information, O tabukasi, O hazard ushabio for intravelo aviation activity, O military service. Part 2 of the application. Medical information: health history, O Part 2 focuses on the proposed insured's health and asks a number of questions about the health history. O this medical section must be completed in its entirety for every application. O depending on the proposed policy, this section may or may not be all that is required in the way of medical information. The individual to be insured may be required to take a medical exam and/or provide a blood test or urine specimen. Part 3 of the application. Agent's report statement. Agent's personal observations of the applicant. Includes the applicant's financial condition, character, background, purpose of sale, and how long agent has known the applicant. Part 3 of the application is often called the agent's report. This is where the agent reports personal observations about the proposed insured. Because the agent represents the interests of the insurance company, the agent is expected to complete this part of the application fully and truthfully. Policies below a certain face amount, such as $50,000 or even $100,000, will not require additional medical information, other than provided by the application. However, they require a medical report for further information. Credit reports. An applicant's credit history is sometimes used for underwriting and to determine the likelihood of making premium payments. The Fair Credit Reporting Act requires the applicant be notified in writing if a credit report will be used. The applicant must also be notified if the premium is increased because of a credit rating. Warranty. Warranties are statements that are guaranteed to be literally true. A warranty that is not literally true in every detail, even if made in error, is sufficient to render a policy void. Representation. Statements made by applicants that are substantially true to the best of their knowledge, but not warranted as exact in every detail. Medical report. A medical report is sometimes used for underwriting policies with higher face amounts. If the information in the medical section warrants further investigation into the applicant's medical conditions, the underwriter may need an attending physician statement (APS).